Hello, everyone, and thank you for joining us today. My name is Kelsey Lefebvre. Before we get started, I'd like to offer a few technology tips to keep in mind while you're viewing today's webinar. First, all attendees are muted throughout the presentations. Once in a while, it's a good idea to tap your mouse so that your screen does not go to sleep during the presentations. There will be time for questions and answers at the end of the presentation. Questions can be text chatted in at any moment during the presentations. To send your question, click on the question mark box button in the right side of your screen to expand a question box where you then can type in your question. A recording of today's webinar as well as all presentation materials will be available at farmcrediteast.com as well as on our YouTube channel. And then a quick disclaimer, this information is presented in good faith and is not intended for investment, tax, or legal advice. So today, a quick introduction. We have Chris Wolf, the E.V. Baker Professor of Agricultural Economics at Cornell University presenting. And then we also have Megan Clancy, Dairy and Livestock Risk Management Specialist from Crop Growers, joining us today as well. Now I will hand it over to Chris Wolf.
Thanks, Kelsey. You're going to have to remind me what I have to do to share my screen. Oh, wait, I guess that's it, huh?
Yep, it should. Yep, so we see your.
So can you see that slide?
Yep, perfect.
Okay, hold on. Did it? All right, well, tell me if I screw something up on this.
Okay.
Okay, so thanks. Happy to be here today. Talk about the outlook for the coming year in the dairy markets in the United States. I want to start by reviewing a little bit of 2024 and talk about kind of where we're at, and then I'll talk about the issues that I think are the ones that we need to be concerned with, and then finish up with outlook. So 2024 was a year that started off, especially on class 3, with some pretty low milk prices, particularly when you consider what the feed prices were. So the ratios weren't great. The margins were real tight. We had the first half of the year was not very good looking. But frankly, it was a kind of a tale of two parts here, because the second half of the year, we had some pretty high milk prices. You know, you have to keep in mind that feed prices and labor costs and fuel costs and everything else is up. So, these margins, a $25 milk price is not what it used to be, right? $25 milk price prior to the inflation that we had, particularly in 22, would have been a much better milk price. So, still much improved. The margins were pretty healthy in the second half of the year. And my understanding from talking to some people is that there's some pretty good years as far as income on some of the dairy farms from 2024. So pattern was class 3 pretty much up from, low in the spring, high in the fall. That's kind of what we expect. Class 4 milk prices were consistently in that $20, $21, $22 range. Class 4, which is milk for butter, right? Class 3 is milk for cheese. Class 4 has just been kind of a consistently strong market for the last few years. The demand for butter and cream and all things that are full fat yogurt, full fat ice cream, full fat beverage milk has been strong, and it's just kind of kept that market fairly consistent. The all milk price, that's for the United States, not for the Northeast. Still, the Northeast price is going to be pretty highly correlated with that, and that again peaked in the fall. So the resulting income over feed cost margin, this goes back for 5 years through 2024 and back to 2020. The yellow line that's on there is the dairy margin coverage trigger price for tier 1, which is 950 a hundredweight. So just kind of for reference, and historically, that's towards the middle of where we've been, that kind of yellow price. And you can see we don't spend much time at that price level, although at the beginning of the year we were below that price level for income over feed cost margin using the US numbers. But by the last 5-6 months of the year, record high margins, not adjusted for inflation, which is important, okay? Because again, We've had significant amount of inflation, and that, you know, $15 today is not what $15 would have been back in 2020. Still, healthy margins. The market is, you know, basically saying produce more milk, and there's some reasons that we kind of haven't necessarily done that. This is U.S. milk production. The latest numbers that are available are for November 2024. On Friday of this week, we'll get the next report, which will have the December of 2024 numbers. The story here on milk production for the United States in 2024 is flat, and really the third year in a row of flat milk production. We've been right around 226 billion pounds of milk production on an annual basis for the entire country for essentially 3 years in a row. November was down 0.1% over a year earlier at just a little under 18 billion after the previous 2 years had been 18 billion. So, but it's not necessarily uniform around the country, and we'll get into that. But what's important, of course, is components. Farmers get paid based on the butter fat, and if they're in a multiple component order, the protein. If they're in a skim fat order, which we are not here, then they just get paid on butter fat, essentially. And that will change a little bit given the fact that we now have made some changes to the orders that will go into effect, some of them in about 6 months and some of them in about 11 months. Anyhow, the point of the story is that while milk production was essentially flat for 2024 and 2023, prior to 2022, components were not. So this just shows you the average butter fat test for milk. And we're going to finish 2024 at right on about 4.2% butter fat on average. Now that is in contrast to a long period that we had there, which is goes back into the 80s. Well, actually it goes back further than that. It goes back into the 70s, where we were sitting there at about 3.6, 3.65, sometimes near 3.7% milk fat for several decades, and really started to take off in 2010 a little bit, but took off much more in 2016. And we've seen butter fat, and you get the complementary product, you get the proteins with it. And so protein also increasing over this, although not to the extent that butter fat has. And this is related to the genetics and the nutrition, the management, all of that stuff coming together. But while milk production was flat, butter fat test was up about 1.5%. So that's a little bit under trend milk production growth, but still that makes up for most of it, right? And so milk production in total flat, but components up, and that's what matters because that's what we use to make into things. U.S. milk cows, this goes back 5-6 years here. December 2024, we were 20,000 cows more than we were in December of 2023. So, and that you got to keep in mind, we've had real tight heifer numbers really for the last 2 years. We're keeping a lower kind of heifer to milk cow ratio than we had historically. Part of that is because of the genetic testing and the sex semen, so that you can pick out exactly which dams you want to mother your next generation of replacement heifers. Part of that is also because the sex semen on the other side, then you can take the rest and breed it to beef. I'm not going to talk about that this year. I talked about it more last year, but estimates are that about 15, some people are saying 15% of the steers this last year that went to slaughter were beef on dairy crosses. And that's become a real profit center for a lot of farms. In fact, there's farms that are seeing as much between their cull cow prices, which I'll get into, and the steers that they're selling, or bull calves that they're selling, that's a real profit center. Whereas for a long period before this, that really hadn't been a profit center. So we're tight on heifers. What can we do about that? Well, one thing is if you got to go buy them, I'm hearing $3,000 or more on replacement heifers a lot of places. I think some people would be happy with $3,000, which is to say that it's higher in a lot of places. But if we look at just dairy cow slaughter for the year, for 2024, it was down almost 12% over 2023. And so, right, if you don't have replacement heifers to bring in, then you're going to have just less culling for repro reasons. If you can keep her around, change the voluntary culling, that you have some flexibility there, although maybe that's not exactly the performance that you want in terms of calving interval and days in milk and things like that. But that, if it gets profitable, you can certainly have longer calving intervals, keep cows, they're going to be profitable more days in milk, and that's kind of what we're seeing. So, slaughters down a pretty significant amount in 2024 compared to a year earlier, and the longer run trend there, 5-year trend, is definitely with a lot of variation, but definitely on a downward trend. And the slaughter cow price has been going up for the last 4 years. And, we got over $140 a hundredweight on cull cows here in, later in 2024, which is a pretty healthy price. And again, that cull cow and calf sales is become a profit center for a lot of dairy farms. So that's kind of where we're at the current time for the most part. So these are my factors to watch. Again, you want the best prediction that we can come up with. We're going to be looking at the futures and options markets, and which do a good job over the long term. And the futures markets are an unbiased and efficient estimate of the forecast of the milk price. But where do they fall down? Well, in predicting shocks, and there's a reason that they're called shocks, right? Which is that we just can't predict them. And so if we're thinking about where are things that could happen that could be particularly worried, obviously on the downside for milk price, or on the upside for feed price, this is what I've got. I've got on the demand side, the trade issues. I'm going to get into these in a little more detail. The domestic economy, I'm not going to talk about that much right now. Right now, the economy in an aggregate sense is doing pretty well. Unemployment's low. Inflation is a little bit above target, but not too bad. GDP growth was real healthy for the third quarter, which is the last one. We'll have the fourth quarter coming out before too long. Consumer spending, right now it's a little bit weaker on food away from home because that's gotten expensive, but so far it's been pretty resilient, and so the domestic economy looks good. And so then we think about what's international economy, and that's where I'll get into trade. Again, we've got the new plants coming online, both in New York State and elsewhere on the country. On the supply side, we've got some important disease factors that we're watching. We've got the potential for labor disruptions, which I'm not going to get into a whole lot, but we're thinking about if we were to have changes in immigration laws or immigration enforcement and things like that. We've always got weather, both on the feed side in the United States, but also particularly on the corn and soybean production in South America. And then the new plants have both the supply and the demand aspect to them. So here's a graph from National Milk Producers, or a figure I should say, that just shows some of the forthcoming or recently completed dairy processing investments. And so the gold ones are cheese in particular. So there's a cheese, Great Lakes cheese in Western New York. We've got Hilmar and Leprino in Kansas and in Texas. We've got some reinvestments, and some of these are reinvestments, some of them are expansions, some of them are new investments. And the ones, particularly the ones in Kansas and Texas for the cheese, are pretty big ones that are coming online. And so part of the question is, are we going to be able to produce enough milk to fill these plants? You simply can't invest $500 million to $1 billion in a new plant and not run that plant, right? It just doesn't work. So these plants, a lot of them have contracts for at least a portion, if not most of their milk. And that will pull some cheese or some milk into cheese, and that probably will pull some milk away from things like butter. And so if we're thinking about that, how does that balance out? Does that mean that we have some capacity that's going to get retired so that we don't have a massive amount of growth in production? Does it mean that we're going to need to find new homes as far as exports? Because we are increasing our cheese consumption, but I don't know if we're increasing it enough to soak up all of the new cheese production capacity. So we need to be competitive internationally, which we are in general. In upstate New York, you see there's 5 stars there. I don't know that those are exactly where those plants are. In fact, I would say they're pretty much not. But Fairlife's got the new plant coming on. Cayuga Milk Ingredients has got an expansion. Upstate Niagara has got reinvestment expansion, I believe. Great Lakes is the cheese. So this is good news in that sense. But what does it mean for the balance as far as where milk is flowing to? What does it mean as far as the balance of the product mix across the country is something that everybody's kind of watching. And just, if we need more milk to fill this, where's it going to come from? Even if we make a decision today to breed a cow to get a replacement heifer, we're looking at 2 years until age of first calving. So, and side note, the beef herd is at the lowest level. The beef cow herd is at the lowest level it's been since somewhere in the mid 1960s. I did look it up, but I don't remember what the date was specifically. And with no signs given these kind of current prices that they're looking to rebuild. And the only way we rebuild is if they start holding some young stock back instead of sending them to the feedlots. And so, we're probably looking at, I'm not saying that the cull cow prices and the beef and the steer prices are going to stay where they are, but we're probably looking at some pretty healthy opportunities there for at least the next 2 or 3 years. From when I talk to my colleagues that work specifically in the beef industry, they think it will be 3 years before we see much growth there. So I guess we'll wait and see there. This is milk production for November of 24, and this is compared to a year earlier. So, again, the December number will be coming out here at the end of the week on Friday afternoon. So this is the latest numbers that we have. And the reason I put this up here is what really jumps out at you, right, is California, which was down 300 million pounds compared to a year earlier for November, which was a 9.2% decline year over year November milk production. And that was with cow numbers. I'm saying cow numbers unchanged. I think actually technically cow numbers were down about 1,000, but California has a lot of milk cows. They have 18% of the milk production in the United States, so 1,000 cows is not enough to matter there. So essentially this 9.2% reduction in milk production of the state of California was all due to milk per cow. And why was that? Well, there were probably some other factors. It wasn't the fires. That wasn't around at this point, and frankly, the fires are, for the most part, not near where we're talking about milking cows. So for California, it was high path avian influenza, right? The bird flu. This is total confirmed cases kind of over the time, and the first one was at the end of March or the beginning of April of last year. So 10 months ago or so, 9-10 months ago was the first one, and you can see where we've had cases. And this is just the cases in cattle. This is not the cases in poultry. That's a different map. But a lot of major milk producing states, obviously California being the top milk producing state, Idaho being third, Texas being fourth, Michigan being 6th or 7th, Minnesota being up there also in the top 10. So lots of major milk producing states, but we haven't seen the same necessarily production decline. Michigan has had a reasonable number of herds that have tested positive, but you can't really tell looking at the data. Now, maybe there's some foregone growth that we would have seen in Michigan, but it doesn't really show up as much in the milk per cow there. It really does show up in the milk per cow for California. So this is as of December 12th, and I just downloaded the new one before we started here. I'll throw up January 2nd here. 16 states, 832 dairy herds, with 142 of the herds in December alone out of California. So in December of 2024 alone, 142 herds in California, and there's roughly 1,000 dairy herds in California. So that's 14-15% of the number of herds in the entire state testing positive for high path avian influenza. And then on December 6th, so a little 6 weeks ago or so, USDA announced that they were going to do much more widespread testing, testing of the silos and stuff, and then tracebacks if they needed to do that. And that was in addition to an order that was already existing that said that you can't move cows interstate without having a test done before that. In any event, this is milk per cow by month going back to 2020. California is the blue line. Wisconsin and New York are the orange and the gray line, respectively. Now, Wisconsin and New York do not have, knock on wood, high path avian influenza. So what I was looking for here was some estimate of maybe what kind of the impact has been on California. And you can see the red vertical line is when California had its first herd confirmed with high path avian influenza. So there is kind of a seasonality here, which is that you see the milk per cow in California, the blue line dips below the Wisconsin and the New York one every year, and that's summer, okay? Where you see that blue line dip below, that's when the heat really impacts the Central Valley of California. So that's, particularly July and August, and to a lesser extent September and June. And then California milk production tends to recover, right? So you kind of get this seasonality below it in the hot months and then catching back up in the winter and early spring and then dropping below it in the hot months and so on. And so it does that, except it didn't do that in 2024. So instead of recovering in October and November and to some extent September like it typically does this year in 2024, and this is only through November, so we don't have the December number in here until Friday. But if you look at it, it's essentially, it's 200 pounds a cow, at least, below where it should have been for the month of November. And that is across all cows in California. And, so the sick ones are obviously gonna be a bigger drop than that relative to the healthy ones. So it's a serious decline. And so the state of California down 300 million pounds. The rest of the country was actually up about 200 million pounds, which took, or maybe a little more than 200 million pounds in November. So that kind of made up for it. But we're even with the growth that we're seeing in like Texas and Idaho and other places, it didn't entirely make up for that. And I think part of the question going forward here is how much does this outbreak like continue? At what point maybe could we get a vaccine, particularly for cows? That we have seen outbreaks in the domestic birds, so in the poultry flocks, have been really seasonal in that there's been spikes the last couple of years. In the spring, one spike in the spring and one spike in the fall, and that's related to migrating birds. So when the birds migrate up from the south, they bring it with them as they pass through an area, and when they migrate back south in the fall, they take it back down with them. And are we going to see the same seasonality in this in cattle? I think that's a big question. And so far we have not seen this have a demand impact, and we certainly hope that it doesn't have a demand impact. And it shouldn't, by the way, because they've definitely tested it, and pasteurized milk is fine. But this would be, I would say, as a side note, a particularly bad time to think about doing broad legalization of raw milk, because that's a terrible idea. It's a bad idea in general. It's particularly a bad idea when we've got a disease that might be spread through milk. And then this is just the latest number that just came out. So this goes through January 22nd, and we've two states in the last, so this is the last 30 days. Two states, which is California, which had 48 new confirmed herds in the state, and Michigan, which had 1. And Michigan had it previously, but hadn't had a positive herd for a few months. And again, there must be some cows, or it seems likely there's some cows that are asymptomatic, because Michigan hasn't really had the decline. Of course, they also haven't had the number of cases that California has. All right, and then disease is not just a US thing. Europe has been dealing for the last couple of years with blue tongue, but it doesn't seem to necessarily be getting better. And this also has a seasonality because it's a virus spread by biting insects. I think part of the deal probably was not as harsh a winter last year, didn't knock down the insect population as much as maybe they would have liked. This affects ruminants. So this map here is not just cows, it also includes sheep. In fact, a lot of these cases are sheep, is my understanding. There's like 30 known variants of blue tongue. So part of the deal with coming up with a vaccine on that is getting the variants right. and all of the other complicating factors that go with that. And the best estimates are that blue tongue causes milk loss of at least 2 pounds a day, which is a kilogram, for 10 weeks. And so that's also kind of putting a damper on milk production. And you guys may have heard that there was a positive herd in Germany, positive for foot and mouth disease last week. That was a water buffalo herd in Germany, and water buffalo that they have there to make that specialty mozzarella that they make with that really high fat milk that the water buffaloes produce. So Germany has been in the process of drawing that 10-kilometer ring and then testing on that to confirm, and nothing has been reported as another positive case. So hopefully that was a strange one-off and not something that they have to deal with. But if there was foot and mouth, that's the first foot and mouth outbreak in Germany in like 40 years. The previous outbreak in foot and mouth that happened about 20 years, you may recall, 20 years ago, was in the Netherlands and was in, I think, Belgium and maybe the United Kingdom. I'm getting a little rusty now, but it wasn't in Germany at that point in time. So where are we sitting as far as supply and demand in this country at the current time? Butter stocks, and this is November, the 2024 number there is 213 million pounds in storage. That's essentially flat from a year earlier. So we had milk or butterfat production go up roughly 1.5%, but we didn't put any more butter into storage, and consumption is going up, right? So flat on storage means stocks to use is actually down a little bit. So not catastrophically low or anything, but certainly not, that's not bearish at that point. Butter prices have been kind of hovering around the 250 to 260 level for a while, and we're pretty competitive on that, although we don't export a lot of butter compared to the other protein products that we export. This is non-fat dry milk, which is the complementary product butter, right? And the stocks there, a little bit more than what we had last year, but not super high, especially not when you look at some of the values we had back 7-8 years ago. Non-fat dry milk prices, you got to look at the vertical axis on this. The bottom of it is $1.34 and the top of it is $1.41. So flattish for the most part, a little bit down recently. Cheese stocks actually are a little bit tighter than we were a year ago. So 1.34 billion pounds of cheese in total in stock. That's 7.2% below a year earlier, which we would think would give a little bit of strength to the cheese market. But again, remember, we got a lot of cheese capacity coming on, but it won't all come on at once. Even when they open those plants, it takes a certain amount of time before a new plant can make cheese that will meet test. You got to work through the kinks and get it all working. And it usually takes several months for a big plant like that to ramp up process. But still, we do have some of those coming online before too long, and that might certainly make up for some of that cheese production. The cheddar cheese prices have been kind of $1.80, $1.85 recently, but a little bit up and down depending on what the news is as far as stocks and as far as production. And then some of the new federal milk marketing order rules that we've got coming on change some of the basis a little bit. You can see those in the further out months when that's coming on. This is dry whey, which of course is the complementary product to cheese, but you have to keep in mind, so the stocks are actually pretty low for dry whey, and part of that is that we don't produce as much dry whey as we used to. The new cheese factories that are coming online, in particular the big ones, tend to do things like produce whey protein concentrates and whey protein isolates as opposed to dry whey. And dry whey demand has been pretty strong because there's a lot of people eating high protein diets, and it's a good addition to things. So, but stocks down almost 19% year over year. And dry whey prices have been strong recently, 75 cents or so a pound, which are historically strong dry whey prices, and that's been very supportive of class 3. So, among the unknowns looking into 2025 is the new president and what's going to happen There were a lot of executive orders signed in the last couple days. And, you know, some of those are going to be fought about if there's some way to fight about them in court, probably. But when we're looking at the dairy industry, we're mostly thinking about, well, 2 or 3 factors in particular. One is what happens with trade. Second one is what happens with labor and immigration enforcement. Can we get some set of coherent labor rules going forward that would certainly help industries that use labor, like the dairy industry? And then there's other issues like what happens with the nutrition programs in the next farm bill, what happens with the energy programs, and what happens with particularly the energy programs that affect the grain prices, like the blending credits and things like that to go with corn ethanol or soy diesel and stuff like that, which will affect farmers that are growing those crops, but also affect farmers that are feeding those crops, right? So we don't know exactly how this is going to go. I don't think anybody can reasonably necessarily say what the goal is going to be on some of these. So that is a set of uncertainty that is going to be a big part of the story, not just for the dairy markets, but for all markets going forward for the next year or 4 years. So this just some headlines from the last couple days, you know, set to toughen the line on China. China's, you know, our biggest trading partner in general, and a very important trading partner for dairy and for corn and for soybeans and for pork. And okay, and then actually it is time to deal with the USMCA, which replaced NAFTA. So the US, Mexico, Canada, which is what we call it. By the way, they don't call it that. In Canada, it's the CUSM. And in Mexico, they probably started with an M. So, but that's 5 years old, and it was set up to have a 5-year review. So it would be expected that we do a 5-year review of the USMCA at this point in time. And so there's no need to have a trade war if that's what you want. But historically, the last time he was president, we did have a trade war. And so there's a lot of people that are concerned that that's what we might be talking about, since he has said on February 1, there's going to be across the board tariffs of 25% on Mexico and Canada, and now 10% on China, which is different than the earlier statement, which had been 60% on China. As an economist, I'd like to see the markets work and don't do any of that stuff, but whatever. This is all U.S. dairy exports by volume on the top graph. Okay, and it's been weaker in the last 2 years, but mostly flat in the last year as far as volume. The value of the exports has been down a little bit because prices have fallen over that time, particularly in the skim milk powder, dry whey, lactose, that tend to dominate a lot of the exports that we do. Because what we do in this country, for the most part, is consume the butterfat production domestically and export the proteins that we don't need. And that's been working out well. The bottom line there is all exports, so U.S. exports, so imports into China. And again, the peaks in 2014 and 2022 are both, you might recall, correlated with peaks in the domestic farm milk price here. And so when China has come in and bought a lot, that has been very helpful. China, the trend has been for the last couple of years a downward trend as far as the volume that they've been buying. And part of that is that they have kind of finished rebuilding their swine herd in some sense, and so they haven't needed as much. But part of it is also that they've tended to go other places, in part because we have put on tariffs, and we did, you know, those tariffs back in 2018, and that kind of still has had a lingering effect. So this is dairy exports into China. The quantity is the blue line, which was also what was on the previous graph, and the value of those exports is the orange line. So you can see up and down as far as quantities and values, but really value down 7% year over year through November. That's what's important, is the quantity's been flat, value's been down, they've been importing, which might mean that they're importing just lower value products. Okay, then this is if you put these three countries together, we have over half of the dairy exports that we have. So, if we're looking at individual countries, we're thinking about Mexico, we're thinking about China, we're thinking about Canada. So this is exports to the USMCA countries, and 43%, and that's been the consistent number for the last couple of years, 43% of US dairy exports by value go to Mexico and Canada. So if we did have something that was kind of tit for tat trade dispute, and they did put tariffs onto our dairy products, additional ones, particularly Mexico I'm thinking of here, because we have a limited amount of access into Canada because they have their production quota system and they can't have a free market system and keep their domestic farm milk price at roughly twice, 1.5 to twice what ours is. Just doesn't work that way, right? Which is why the USMCA negotiated additional access into Canada, which I'll get into in a second. But Mexico, US dairy exports into Mexico don't pay any tariffs. And that goes all the way back to the implementation of NAFTA. Okay, and so it's been true for a number of years. So if they did put tariffs on, that would be new tariffs, which would directly hurt our competitiveness, particularly when you consider that Mexico a few years back signed a free trade agreement effectively with New Zealand, which they're implementing. And so, if they were to put tariffs above where the New Zealand products were, then we would be at a distinct disadvantage exporting into Mexico, which would not be great. And if we look at value year over year through November for the first, so those lines tip down a little bit on the end, but mostly that's because the December numbers aren't in there. So if we just compare year over year, January through November, Canada, value of exports to Canada up 6%, value to Mexico is up 5%. Be nice to keep that going. Would give a lot of support. And then this is just a graph to show you the months that China put in new tariffs on US exports of whey to China, which happened in July of 2018 and then came off in the early part of 2020. And you could see the volume that we exported was kind of directly and significantly affected. So that's what happened the last time, and we certainly don't need that. That would be a distinct risk that we're looking at the current time if we keep moving down this road. Then this is just to show you some research that I recently completed. This is just the value of US dairy exports to Canada prior to that first dashed line. So to the left of the first dashed line there is before the USMCA went into effect. And then the first dashed line, the solid part is what actual exports were. The dashed line is what we estimate the exports would have been without the USMCA agreement. So the difference between the solid line and the dashed line is basically the increased exports because of the USMCA. But you may recall that the United States was unhappy with the way Canada was allocating. So the way it works with Canada is that we have what's called tariff rate quota. That's what the TRQ stands for. And tariff rate quota is the amount of each product that we are allowed to export to Canada with no tariffs. And above that amount, then the tariffs kick in, and the tariffs are big. The tariffs are up to 290% tariffs on these products. So if a pound of cheese was $1, they would put a $2.90 tariff on that, and it would cost $3.90 in Canada, which would make it, of course, not competitive in a lot of cases, right? So what's important is the access that we have, which is roughly 3.6% of the market in Canada. That's before we hit those big tariffs. But what Canada did is they allocated those TRQs, so the quantities that we're not going to pay the tariff on, they allocated most of those tariffs in some of the dairy product categories to processors for further processing. So in fact, in some of those, it was 85% of the tariff rate quota was allocated to processors for further processing, which means that if I was in Canada and I wanted to import cheese, I could only bring cheese in if I was going to further process it into something else. I couldn't bring blocks of cheese in and then just sell it as cheese. to consumers. And so the U.S. asserted, and I think there's evidence to support that by allocating most of that TRQ to processors, you're limiting the kind of incentive to import into Canada. So just, let the retailers have more of the TRQ so they can import and sell directly instead of needing to do further processing. And so we had that dispute with them during that period between the two vertical bars. And then following the second vertical bar is when the new kind of rules went into effect, which is to say that we kind of partly won the dispute and then partly didn't win the dispute. And Canada made some changes. So now, again, the solid black line on top is what our exports have been to Canada since that time. The dashed line is what they, well, the difference between the solid line and the dashed line is what they would have been without the USMCA, and then the blue line is what they would have been if we didn't kind of win partly that dispute. So you can see that the value certainly has been a positive for the U.S. dairy industry. It's not necessarily huge at the farm level, but it is an impact, and it did have a positive impact on farm milk prices, everything else equal. So we don't want to kind of undo these things. But when we have these export disputes, I will have three graphs here I want to show you that I think hopefully helps kind of frame where we're at. So dairy exports for the U.S. in 2023, which was the last complete year, was $8 billion. $8 billion. And by the way, that is down in value, but essentially flat in quantity compared to the year before. So in 2022, it had been $9.1 billion. The quantity stayed the same, prices came down a little bit. It was $8 billion in value in 2023. That's a little bit less than 20% of the value. It's 15% or a little bit more of the value at the farm level of the milk that we sell. So it's important. If we didn't have export markets, prices in this country would be significantly lower, or we would be producing significantly less milk. Okay, so this is what's at risk. Countries have noticed that if they put tariffs on U.S. ag products, that will get a political response here, and they're not wrong, because this is what's at risk for the dairy industry. Now, for the same year, which is 2023, if we look at all U.S. ag exports, would be a little bit shy of $174 billion. So the $8 billion is important to dairy, but it's 4% of all U.S. ag exports. So there's 96% out there that's not dairy, and those people have their own constituencies, they have their own lobbyists, they have their own stakeholders, and that's going to be part of the overall decision, is not just what happens to dairy, but what happens to U.S. agriculture. And that's a big part of agriculture. But this is what we're looking at for all exports from the United States, which is $3,050 billion, which is $3 trillion. So that $8 billion for the U.S. dairy industry is still on the graph, right? This line is still there. But it's rounding error compared to what we're looking at potentially for the value of trade, because the biggest things that we export are technologies and things like that, machinery, equipment, technologies, services, other things like that have a much bigger value. And if we're thinking about kind of in an aggregate sense, who might be the most important considerations in that, you gotta keep in mind that $8 billion is important for U.S. dairy, but it's a rounding error on the big trade thing. So I think that's kind of just context that I wanted to add there. So enough on trade. This is the major milk producing countries' milk production compared to a year earlier. The yellow line is 0. So if it's below the yellow line, then it's below a year earlier. And you got to keep in mind 2023 was down in aggregate from 2022, and 2024 was, at least in the second half of 2023, and 2024 for the most part has been down compared to 2023. So we haven't seen strong milk production globally. The European Union, milk production up 0.2%, so essentially flat. Keep in mind, US milk production up 0.1%. Australia and New Zealand up a little bit, but New Zealand in particular, that's from a lower values the year before, so higher in 24-25 compared to 23-24, but lower. That was off of a number that had been lower from a year earlier, and the same thing with Australia, which had been kind of struggling in recent years because of a whole bunch of different issues that have been going on down there, weather issues and other things. So globally, milk production flattish. If we look at milk production or milk prices at the farm level around, so raw milk prices, farm level around the world, we're looking at the US is the red line, New Zealand is the green line, and the European Union is the blue line. This comes from the European Union Milk Observatory, which I think is useful to look at. This is their estimates of the farm milk price, and these are in euros per 100 kilogram at 4.2% milk fat, which of course we don't use euros, we don't use 100 kilograms, and we don't price it at 4.2% milk fat, but this puts it all on the same basis because that's how Europe prices it. If you want to put it in dollars per 100 weight, it's 3.5% butterfat. You're going to divide by between 2.1 and 2.2 to get in that neighborhood. The point is that we are lower than Europe in the most recent month, which is November of 2024, but above New Zealand. In fact, we're sitting almost equidistant between the New Zealand and the European milk prices. So, you know, these prices tend to converge and then diverge depending on what the specific situation is. New Zealand is mostly doing products in the international market. European Union is mostly doing products for the domestic market, and the US is doing kind of a balance. So, but we're definitely competitive, and there's no reason to think that there's going to be strong downward pressures just from this at the current time, because the milk production is pretty flat worldwide. And if we keep having these disease and trade issues, that is not going to help. This is where the dairy futures markets closed yesterday. So the futures markets has class 3, which is the blue, at $20.36 or something of that nature, and then kind of trending downward over time. Keep in mind, part of that drop in June and is the fact that we've got federal milk marketing order rules coming in, which changed the make allowance, which everything else equal would be lower class 3 and class 4 prices, and that's part of what the market is adjusting for there. And class 4 prices, you know, staying stronger in that $20, $21 to $20.50 range for the year. So downward from higher prices, but what also matters is what happens with the feed prices. You guys probably noticed that the week before last, USDA came out with their WASDE report, the World Ag Situation Supply and Demand Situation Outlook, and they lowered, they revised down the U.S. corn yield from last fall down by 3.8 bushels, and soybeans down by 1. That 3.8 bushels is really a lot to drop that. And what they decided was that there was more dryness than they had, and the drought, particularly in the Corn Belt, in the Eastern Corn Belt, in Ohio, and some other places in southern Minnesota, it had a bigger impact than they originally thought, and they lowering it by 3.8 bushels per acre on all the acres, right? There's 91 million acres of corn. So that was nearly a $200 million drop in what they thought the ending stocks were. So we went from a pretty big ending stock to one that was much more normal. And so you can see this is the futures, corn futures on the Chicago Board of Trade. And you can see when the announcement, right there, when the announcement happened that we had, according to the USDA, 200 million less bushels of corn in storage than we thought we did, right? So we went from a corn price, which was a little bit better than it had been if you're selling corn, and a little bit worse if you're buying corn, at around 450, 455, and jumped up to that 475, 480 range, which is more like where we are now, looking at going forward, at least for the nearby months, until we see what happens, particularly out of South America, and what happens with trade, and what happens with the fuel rules as far as the blending credits and the ethanol wall and all of that. So this is where the WASDE was. So the first two columns, 22, 23 for the crop year, and then if you look below, the milk is always in calendar year. So I'm doing milk in calendar year, and the crops are in crop year. All right, so harvest to harvest. So I've got 22, 23, 23, 24 that so that you can compare the 24, 25F. That's the WASDE, the most recent USDA forecast. 425 corn, 1020 beans, 310 soybean meal. The futures as of last night were 474 corn, 1003 soybeans, 306 soybean meal. That's a pretty good increase or difference there. And the WASDE will be looking at a new one next month, and I'm assuming they'll probably come up a little bit, or else the futures needs to kind of converge a little bit there. If we look at the all milk price, actually all milk is the WASDE number for the 2025F in the first column. The 2025F in the second column is my projection for the US all milk price. So I'm $1.80 lower than they are, which is a lot. So one of us is going to be wrong. Probably me, but I think they're crazy. Class 3, they've got, and this is almost 2 weeks, well, it's a week and a half old. 1970 from USDA for WASDE for class 3 and 2080 for class 4. Futures yesterday was at 1911 and 2055, so that 60 cents on class 3 is a pretty big difference. This is where the dairy margin coverage tool was forecasting as of last night. Corn price is a little bit low, in my opinion, on this one, and the soybean meal is right on. And hay, who knows? Hay is all about weather. Hay is just going to be weather, right? Local hay prices, in particular, they really depend on weather. We get some moisture in the right places. Hay is going to, the $200 a ton is not completely unreasonable, but it's a little bit on the low side probably. Where I disagree with this forecast is the all milk forecast, because given where the futures prices are right now, there's no way we're going to have a $4 basis. That would be a historically high basis. And then if you look at the resulting margin, which is the column on the far right, $14 margins are not typical. And a margin that averages $13.80 for the whole year says, man, make milk, make a lot of milk. And I just don't think I don't think we can hold that. I don't think we can stay there. Even though we did get to that 15.50 margin at one point this last fall, it didn't stay there. So here's where we're at. The gray line is what the income over feed cost margin has been, which is not profit, but is highly correlated with profit, right? It's what you have left to pay off everything else, the labor, the fuel, everything else. So it's correlated. So higher gray bar has been a higher on-farm profit for most farms, unless they have some weird situation going on, like you have a herd health train wreck or something like that. So the dashed blue line is what the DMC tool was saying as of last night using the futures and options. The green line is my forecast. So I don't think we can hold that $14 margin. I think it's going to be, well, trending downward. I think, now, I could be wrong, but my forecast is that the margin averages is more like 11 something for the year instead of almost $14, which would be an okay year, not a great year. But all of this, of course, depends on what happens with trade, what happens with weather, what happens with the domestic economy and consumption, what happens with China's economy. So there's lots of factors going on, but that's my best estimate of where we are today. And I will stop right there and let you guys.
Yeah, thank you. So Megan, I'll switch it over to you, and you should be able to share your screen now. And then feel free to type in questions while Megan's presenting, and then afterwards we can get to answering some of those. Looks good, Megan.
Sounds good. Thanks, Kelsey. Good afternoon, everyone. Thank you all for joining us today. My name is Megan Clancy, and I'm one of the dairy and livestock risk management specialists here at Farm Credit East and Crop Growers. Thank you, Chris, for giving us a great overview of markets, where things are at, and a lot of the volatility that we're facing. And to your point, I just saw an article this morning, and the headline read, "Milk Markets Seeing Rising Volatility." So now I want to ask all of you, before we start this part of the webinar, how prepared are you to weather this market volatility, the financial ups and downs that really seem inevitable in today's dairy industry? We're seeing fluctuating milk prices, input costs changing, and a lot of shifting trade policies. And really all of those factors go into these dynamics. So it's really not a matter of if all of those things would happen, but when they will happen and when they will impact you and your dairy operation. So with that, today we'll focus on giving you the tools and steps to prepare your business to weather some of these uncertainties and challenges and really thrive despite some of those challenges that we see in markets today. So the good news is that preparation can help with market volatility, and that's where dairy risk management really comes into play. It's really about creating a financial safety net to protect your dairy operation from a lot of those uncertainties that Chris talked about. Dairy producers are no strangers to the challenges in markets, whether that's fluctuating milk prices or changing input costs, but having a clear strategy, or at least understanding all of the tools and options out there, are really critical to safeguarding the financial health of dairy operations. There are several different tools to protect milk prices and different types of costs. I'm going to briefly go over them in the essence of time. But the first one listed here is dairy margin coverage, or the DMC program. Chris spoke a little bit about this, but again, it offers protection when the margin between the all milk price and average feed costs fall below a selected threshold. That program is available through the USDA Farm Service Agency. The next tool listed here is Dairy Revenue Protection, or the DRP program. And we'll go over that a little more on the next couple slides, but basically that program sets a floor on milk prices. The next program here is Livestock Gross Margin Dairy, or LGM Dairy. That program focuses also on margin protection. Both the DRP program and LGM Dairy are only available through licensed crop insurance agents. And then the last tool listed here is forward contracts. Those can be done in various ways, but basically it also allows producers to lock in prices and manage their risk. But one of the keys to risk management is really finding the right combination of tools, or using a selection of all of them that really align with your business and your goals. One of the more popular tools is Dairy Revenue Protection. Unlike some of the more traditional tools, DRP allows for greater customization to really meet every farm's unique needs, as every farm is different. This program is on a quarterly basis, and it really allows producers to set a price floor while leaving all of the upside of the market open. Dairy producers can decide when they want to lock in prices, and also how much milk production they want to protect in the program. So DRP can really be tailored to every type of operation, no matter how big or how small. But really at its core, DRP provides a safety net for producers. This ensures that even if the market does take an unexpected dip or downturn, you'll have the revenue stability to cover your costs and also maintain your operation as well. Now I want to take a look at how dairy revenue protection is being used across the US. So this chart here shows the amount of milk production in the US that is protected under the program by quarter from 2020 all the way through the end of this year. So since about 2020, roughly 30% or more milk has been protected per quarter under this program. Those light green bars all the way over to the right-hand side of the screen don't show as much milk protected, and that's because those quarters are still available for producers to protect their milk for. So understanding those tools that we just went over, like DRP and others, are really just one piece of this entire risk management puzzle. The next piece is thinking holistically. And what I mean by that is, how do we use these tools to build resilience and also create a strong foundation for business? A strong risk management plan can help your operation navigate a lot of those uncertainties that we just went over. Again, these tools provide a safety net, and they also ensure consistent cash flow even during periods of a lot of market volatility. So that stability allows you to ultimately focus on the long-term goals of your business instead of reacting to a lot of these short-term challenges and trying to navigate things such as a downturn in milk prices. Risk management also offers support and diversification opportunities for your business. It allows producers to maybe expand areas of their business or even create additional revenue streams as well. And as Chris mentioned, international markets play a really critical role in the US dairy industry in pricing, and trade policy changes can have a significant impact sometimes on the US dairy industry. So a strong plan really ensures that your operation can adjust quickly to a lot of these shifts that we're seeing. And risk management isn't just about reacting to the challenges after they happen. It's really about anticipating them and preparing for them to come. And by budgeting for potential risks, dairy producers can make really informed decisions and also stay ahead of the curve, again, being prepared. But ultimately, all of those pieces there work together to strengthen dairy farms' resilience. Then, as we look toward the rest of 2025, it's really important to have a structured approach to risk management. And as we wrap up here shortly, I just want to provide a roadmap and some simple steps that you can use to go about doing that. So the first step is to simply just understand the risk management options out there. Familiarize yourself with the tools and the resources that are available, because if you're not using them today, maybe you will end up needing them down the road. Step 2 is to assess the risks in your business. So identify potential vulnerabilities in your business, and that can even include aspects outside of milk prices and feed costs as well. The next step is to develop mitigation strategies. So choose tools and solutions, whether that be DRP or DMC that we just went over, to address those risks that you have identified in your business. Step 4 is to implement and budget. Make sure your strategy is practical and aligned with your financial plan. It's also important to budget for the cost of risk management as well. The best plans are really the ones that are actionable and also have very clear set goals. Next is to update your business plan with your strategy, as risk management is very evolving and ongoing, and it can be changed over time. Then lastly is to monitor and review. Don't just set it and forget it. Regularly evaluate your strategy to ensure that it remains effective and is really performing how you need it to. Another part of planning for this year is remembering important dates for these risk management tools. The USDA recently announced the sign-up deadline for DMC. That is March 31st. And again, Chris showed projections for that program. The DRP program also has some sign-up deadlines. If you don't have a policy currently, you can sign up at any point throughout the year. And then if you do have a DRP policy currently and would like to transfer to Farm Credit and Crop Growers, the deadline to do that is June 30th. And then another tool that I didn't touch on earlier, but it is a way to manage feed prices and that type of risk in your business, is spring crop insurance. And the deadline to sign up for that is quickly approaching on March 15th. Another way to stay up to date on some of these important deadlines, the risk management tools that we went over, our livestock insurance analyzer tool, and just general market intel, is through our Dairy Market Insights. This is our weekly newsletter that we send out to basically help dairy producers and others stay up to date on evolving market conditions, as things change very quickly in the dairy industry. And if you scan that QR code there, That will bring up the Farm Credit East website that is shown on the slide for you to sign up. And if you missed the QR code, please feel free to scan it again there. But to wrap up, here's an actionable plan to ensure that your farm is ready for this year. Again, go through that roadmap that we just went over, review your current strategies, determine what's working, maybe what's not working so great, and what you need to change. Next is assess how much milk you should protect, or maybe how much milk is unpriced based on the risks in your business, and is a way to minimize some of your exposure. Once you've assessed this, focus on filling those gaps. Put a plan in place that is proactive and that aligns with your business goals, which could include maybe using a combination of some of those tools that we went over. Then consult with your dairy profit team advisors, whether that be our business consultants, tax preparers, loan officers, crop insurance agents, or maybe all of the above. They are all there to help you implement your strategy and make sure that you do remain effective. Risk management really does involve a team approach for guidance and also to make sure that you're making informed decisions. If you're feeling overwhelmed by risk management tools and really don't know where to start, please don't hesitate to reach out to us. We want to make it really easy as possible for you, and we're here to develop a plan that will work for you as well. Our team has 2 specialists dedicated to dairy risk management that serve the Farm Credit East territory, Casey Slade and myself, and our information is listed there on the slide. And then lastly, our website, farmcrediteast.com, has more information on the programs that we went over, as well as different crop insurance products, and all of our contact information is listed there on the website as well. But now I think we'll open it up for questions, and Kelsey, I'll pass it over to you.
Yeah, so feel free to send in questions. We have one about the Farm Bill, probably more for Chris. I know you talked about it briefly, but it seems like another factor that could influence the industry. So I guess if you can just touch on that a little bit.
Yeah, sure. So they did another temporary extension on the Farm Bill, which doesn't go all the way through 2025. And so, but now with it being Republican House, Republican Senate, Republican President, one would think that they would get a Farm Bill done. And, when it comes to dairy, there could be some changes to the dairy margin coverage program. Certainly there was talk about expanding tier 1 from 5 million pounds to 7 million pounds. And there was talk about allowing farms to update base, which if you had grown and you are below that kind of tier 1, then that would have a bigger impact on you. And if you were already above that tier 1, then it probably wouldn't matter as much for you. But a lot of that will depend on the projections from CBO and what if any trade-offs they are making between commodities on the budget. The nutrition programs are 70 to 75% of the spending on the Farm Bill, and they're important because that's women, infant, and children, that's SNAP, that's school lunch. 7.5% of the beverage milk consumed in the United States is school lunch. So keeping that going is important. The other thing that might happen in the Farm Bill is, as part of the Federal Milk Marketing Order reform process that they just announced the final rulings and results on last week, the make allowances were updated and they increased by quite a bit. They increased by 25 to 40%. And there was kind of general agreement that it shouldn't necessarily take 17 years between updating the make allowances, and that there was a desire to do a regular survey, maybe every other year survey, and then update the make allowances that are used to derive the farm milk prices based on the survey of the manufacturing costs. But that is not something that USDA can do without permission that could come through a bill like the Farm Bill. So if you're the dairy industry, then you're looking to see if that's going to be part of the permission that gets granted here, if you want to see that updated. If you don't want to see it updated, then I guess you'll be just as happy that they don't include it. But yeah, all those things are absolutely important. I would expect the Farm Bill this year. Senator Bozeman is now in charge of the Senate Ag Committee. I would assume that he's going to be, a lot of the discussions last year were about whether and how much to cut nutrition programs. I would think that there would be a lot less of those discussions given that it's all controlled by one party at this point.
Great, thank you. And then another question about why, if you can go a little more in depth about why you're predicting the milk price to be so much lower than the futures.
Oh, actually, yeah, you know what? Let me be careful. I'm actually, so that all milk price is above where the futures prices are. But the basis on my all milk price is between $2 and $2.50, which is historically where that basis has been. And the basis on the DMC tool, which I don't understand, so I'm not going to assign any particular blame to it at this point in time, is actually predicting a $4 basis. So I'm not below, so let me be careful about the way I said that in clear. I'm not below the futures per se. I just have a more conservative basis than what they've got. And you know what? I could be wrong. I don't see us holding income over feed cost margins of $14 for a year. So I still don't think it's going to be a bad year, by the way. I'm predicting more like an average year.
Okay, looks like there's no other questions. I don't know if either of you have anything else to say or comment on, but if not, we'll wrap things up. I just want to say thank you to Chris and Megan, and then just a reminder, the recording of this webinar and the presentation slides will be available at farmcrediteast.com and on our website shortly. If that's everything, thank you and have a great day.
Thanks.
Thank you.